Accounting for income taxes, deferred tax made simple. Hello and welcome to Candy Mentor. In today's session, we'll decode IND AS 12, the accounting standard that governs how companies handle current tax and deferred tax. We'll move step by step, starting with the concept of temporary differences, then move into recognition rules, measurement, presentation, and finally, some real examples. By the end of this class, you'll clearly understand why deferred tax arises, how to calculate it, and how it influences both profits and equity. So let's begin. Objective of IND AS 12. The main goal of IND AS 12 is to make sure that tax effects of transactions are recognized in the same accounting period as the related income or expense. In simpler terms, when your accounting profit and taxable profit differ due to timing, this standard ensures both get matched properly. It helps represent your future tax obligations or benefits faithfully, following the accrual concept, not just cash-based logic. So, expenses or incomes are recognized when they occur, not merely when the tax is paid or saved. Scope and coverage. This standard applies to both current tax and deferred tax for all domestic as well as foreign operations. It covers regular income taxes under the Income Tax Act, withholding taxes on dividends or foreign remittances. However, a few items are outside its scope. Government grants, which fall under IND AS 20, the initial recognition of goodwill, and the initial recognition of any asset or liability that affects neither accounting profit nor taxable profit at that time. So remember, IND AS 12 deals strictly with income taxes, not subsidies or capital contributions. End. Key concepts. Let's define a few basic terms before we move deeper. Accounting profit. This is the profit shown in your financial statements after following accounting standards. Taxable profit. This is the profit as per tax laws after applying deductions, exemptions, and disallowances. Current tax. This is the tax you owe or can recover based on the current year's taxable profit. Deferred tax. This reflects future tax effects that arise from temporary differences between accounting values and tax values. These are the four pillars of IND AS 12: current, deferred, accounting, and taxable. Temporary versus permanent differences. This is the heart of deferred tax. A temporary difference is the difference between an asset or liability's carrying amount in the books and its tax base, the value recognized for tax purposes. There are two kinds: taxable temporary differences, or TTDs, which lead to future taxable amounts. These create deferred tax liabilities, or DTLs. Deductible temporary differences, or DTDs, which lead to future deductible amounts. These create deferred tax assets, or DTAs. Now, a permanent difference never reverses. For example, a penalty expense disallowed under tax law, or dividend income that's fully exempt. These don't give rise to deferred tax because they'll never affect tax later. So, deferred tax exists only when timing differences will eventually reverse. The core formula. The logic of deferred tax can be written as deferred tax equals temporary difference times applicable tax rate. To find the temporary difference, use this formula: carrying amount, tax base, and use the tax rate that is expected to apply when the difference reverses in the future. It's simple multiplication, but built on careful identification of the differences first. Understanding the tax base. Now, what exactly is a tax base? For an asset, it's the amount that will be deductible for tax purposes when the asset's economic benefits are realized. Example: a machine costs $100, and you've already claimed $60 as tax depreciation. The tax base is $40. For a liability, it's the carrying amount minus any amount deductible for tax purposes in future. Example: a warranty provision of 10, deductible only when actually paid. Its tax base is 0. The gap between these book values and tax bases is what drives deferred tax. A deferred tax liability, DTL. A deferred tax liability arises when your accounting income is higher than your taxable income now, but this difference will reverse later. Typical causes include higher depreciation claimed for tax than for books, revaluation gains recognized now, taxable in future, unrealized foreign exchange gains. Let's see a quick example. Book depreciation is 10 lakh. Tax depreciation is 15 lakh. The difference of 5 lakh will be taxable in future, hence a DTL. If the tax rate is 30%, DTL equals 1.5 lakh. You pay less tax today, but more later. That's the essence of a DTL. Deferred tax asset, DTA. A deferred tax asset is the opposite. It arises when accounting income is lower than taxable income now, leading to future tax savings. Common reasons include provisions for doubtful debts or warranties, not yet deductible for tax, business losses, or unabsorbed depreciation that can be carried forward. But here's the key. You recognize a DTA only when there is reasonable certainty of future taxable profits. And if it's based on business losses, the test is even stronger. You need virtual certainty, supported by convincing evidence. So, optimism alone doesn't justify a DTA. It must be backed by realistic projections. End. Recognition Rules Summary. Let's summarize the recognition logic. Deferred tax liability, DTL, always recognized because future taxable amounts are expected. Deferred tax asset, DTA, recognized only when probable future taxable profit exists. DTA from losses, recognized only when virtual certainty is proven. Think of it as a confidence ladder. DTL is automatic. DTA needs confidence, and DTA from losses needs solid proof. End. Initial recognition exception. There are 2 special exceptions where no deferred tax is recognized. First, on the initial recognition of goodwill. Second, when an asset or liability is first recognized, not as part of a business combination, and it affects neither accounting profit nor taxable profit at that time. For instance, recognizing a lease liability at inception that doesn't yet influence taxable profit. No deferred tax there. These exceptions prevent meaningless entries. Deferred tax on revaluation. If you revalue assets under IND AS 16 or IND AS 38, any resulting gain creates a deferred tax liability. Why? Because that revaluation gain will be taxable when the asset is sold. So, you record the DTL immediately. But instead of showing it in the profit and loss account, you adjust it in other comprehensive income, or OCI. Example: revaluation gain 5 lakh, tax rate 30%, DTL 1.5 lakh. You reduce that from OCI directly. Recognition in profit or loss versus equity, IND AS 12, insists on a simple but crucial rule. Recognize the tax effects in the same place as the related transaction. If the transaction affects the profit and loss account, the related deferred tax also goes there. If it affects OCI or equity, the deferred tax must go there too. For example, if you have a fair value gain on an investment classified as FVOCI, fair value through other comprehensive income, the deferred tax is also recognized in OCI, not in P&L. This keeps consistency and clarity. Current tax accounting. Let's handle the easy part. Current tax. Current tax is simply the tax payable or recoverable on your taxable income for the year. The journal entry looks like this. Debit income tax expense in profit and loss. Credit current tax liability in the balance sheet. If you've paid advance tax or have TDS or refunds, adjust them separately against this balance. Deferred tax calculation process. Here's a quick 6-step process to calculate deferred tax correctly. 1. Identify the carrying amounts of all assets and liabilities. 2. Determine their tax bases. 3. Compute the temporary differences. 4. Classify each as DTL or DTA. 5. Apply the correct tax rate. 6. Present the net result in the balance sheet. It's a systematic exercise, part logic, part discipline. Presentation in financial statements. Now, how do we show these items? Current tax appears as a current liability or current asset, depending on whether you owe or recover it. Deferred tax is always shown as a non-current item, either asset or liability. You can offset DTA and DTL only when both belong to the same tax authority and there's a legal right to set off. Deferred tax expense normally goes to profit and loss, unless linked to OCI or equity. Changes in tax rates or laws. Tax laws change, and so must your deferred tax balances. Whenever the tax rate changes, you must remeasure all existing DTA and DTL using the new rate. Recognize the impact immediately in the same place, profit and loss, or OCI if that's where it originated. Example, corporate tax rate drops from 30 to 25%. You'll reduce your DTL and adjust the difference in that period's accounts. Special cases IND AS 12 also applies to a few special scenarios. In business combinations, you recognize DTA or DTL on fair value adjustments. For share-based payments, deferred tax arises on the difference between book expense and tax deduction. For investment property measured at fair value, you create DTL on unrealized gains. For foreign profits not yet remitted, you recognize DTL unless you control when the reversal happens. Each case requires careful review of timing and control. Disclosure requirements. Transparency is key. Your financials must disclose a breakdown of current tax, deferred tax, and prior period adjustments, a reconciliation between the effective tax rate and the statutory tax rate, a breakdown of DTA and DTL by source, depreciation, provisions, losses, and so on. Any unrecognized DTA with the evidence supporting it. Good disclosure tells users where your tax positions come from and how secure they are. Journal entries. Typical flow. Let's summarize the typical journal entries you'll see. 1. For current tax liability. Debit income tax expense. Credit current tax payable. 2. For deferred tax liability. Debit income tax expense. Credit deferred tax liability. 3. For deferred tax asset. Debit deferred tax asset. Credit income tax expense. 4. For revaluation surplus recorded in OCI. Debit OCI, credit deferred tax liability. Each entry keeps the principal intact. Match the tax effect with the related transaction. Numerical illustration. Let's walk through a small example. Particulars, carrying amount, tax base, temporary difference, tax rate result. This definition of detail is an updated illustration of base and front base tax base. Now, let's offset this improve. Then we will offset this improve package. The net DTL is 3 rupees, 6 minus 3. This small table sums up the logic beautifully. One difference adds tax later. The other saves tax later. Comparison with IAS 12. IND AS 12 is almost identical to the international standard IAS 12. The main differences: IND AS 12 adds clarifications for MAT, or minimum alternate tax, and tax holidays. It also uses a stricter threshold for recognizing DTAs, requiring virtual certainty, whereas IFRS only says probable. So, IND AS takes a slightly more conservative approach. Common pitfalls and audit focus. Auditors often flag a few common mistakes. Recognizing DTA without strong evidence of future taxable profits. Forgetting to record tax effects in OCI or equity where they belong. Offsetting DTA and DTL across jurisdictions not allowed. Failing to update deferred tax for changes in tax rates. Avoid these, and your deferred tax accounting will stay clean and defensible. Key metrics and indicators. Here are a few quick indicators to monitor your tax position. Effective tax rate, or ETR, equals total tax expense divided by accounting profit. If your ETR drifts far from the statutory rate, dig into the reasons. It may be deferred timing or tax incentives. Deferred tax ratio, which is deferred tax divided by total tax expense, helps assess how much of your tax is timing-based. Tracking these ratios over time tells a story about your company's performance and tax planning. End. Final checklist for financial close. Before you sign off the financials, run through this quick checklist. Reconcile accounting profit with taxable profit. Identify all temporary differences. Test the recoverability of every DTA. Recalculate for any new tax rates or amendments. Cross-check OCI and equity effects. And disclose everything clearly, with notes, reconciliations, and explanations. This checklist ensures compliance and transparency. End. Closing summary. Let's recap everything. IND AS 12 aligns your accounting income with the correct tax impact. When you see a deferred tax liability, think tax payable later. When you see a deferred tax asset, think tax saving later. Consistency in recognition and matching ensures accuracy, and transparent disclosure builds confidence among auditors, investors, and regulators. Final takeaway. Deferred tax isn't about guessing your future tax bill. It's about recognizing timing differences honestly and transparently. Apply IND AS 12 with discipline, and your financial statements will tell a truthful, professional story, one that reflects both profitability and tax reality.